So this is learning objective 1, which is, I don't know, kind of what's on the statement of cash flows and why is it useful, or what, and I kind of go, what does it look like? So let's look at the illustration on page 628 of the book. And this is where it gives you an indirect method cash flow statement. And you'll notice it's got the 4 main sections to it. It starts at the top with the operating section, and then there's an investing section, a financing section, and then a non-cash investing and financing. I'm not sure if that's on that statement, but that's the 4th category. That would be at the very bottom after everything else. So let's take a closer look at each section. Let's start with the operating. And I'm not going to write out the whole thing, but because hopefully you're looking at it and we can kind of look at it together. We start with net income for the period. So the net income, and this is in the operating section now. So the net income is $145,000. Then we make a bunch of adjustments. So you do a bunch of adjustments. You make an adjustment for depreciation, for loss on the sale of assets, decreases in receivables, increase in inventory, increase in payables. Okay, so we make all of those, and we end up with cash provided by, okay, your operating activities, okay, of 172. Okay, so this is your net income, 145. This is the cash you got out of it, 172. What's that all about? Well, let's think about it. We want to say, well, why would they be different? Why is net income different from cash? So if you think about the various expenses, and I'm just going to make up a revenue number here. So say we had revenue of $500,000, and then we had our expenses of $355, and this is just so you can sort of visualize what this is all about. And then we would come down to net income of $145. Okay, this number right here. All right. So now these expenses here include things like depreciation expense. Now, did we write a check for that? No. That's an expense that decreased our net income, but we did not write a check for that because originally we had a truck or something we bought 5 years ago, and we paid out the money 5 years ago, but we're allocating the cost over its useful life. So we do depreciation expense, but no money flowed out. Okay, so that would be one thing. So the expense, that would be $9,000 in this case, that it reduced our net income, but no cash went out. So that's why we end up adding stuff like that back. And then the loss on the sale of assets was $3,000. Now, you could have a journal entry, and if you remember when you do a journal entry, when you sell something, you could get cash of, 10. You could have a loss of 2 because the equipment, or let's go land, because the land cost 12. The loss does not involve cash. We got cash, but you have a loss. The loss decreases your net income, but no cash went out. Cash actually came in. Okay, so we add back the loss to get from net income to how much cash we have. And so no cash was paid for either of those items, and yet the expenses were deducted to get net income. Okay, then we make all these adjustments for the various current accounts, okay? You're adjusting, it says we had a decrease in receivables, increase in inventory, increase in payables. Let's just think about that for a minute. Why does the decrease in accounts receivable, why do we add that back to get from net income to cash? Well, if you think about the original journal entry that was done, well, actually, let's think about the journal entry that would have accomplished this. We got some cash in, say for $10,000, and we reduce our accounts receivable $10,000. Now this cash came in this period, but did that represent net income for this period? No, it did not. That was in settlement of a receivable that last period we went accounts receivable and revenue last period, that's when the revenue got booked. We're just getting the cash now. So when you have an increase, a decrease in your accounts receivable, we end up adding that adjustment back to get from net income to the actual cash we got. And we could do the same thing with payables. The 2,000 was paid out this year. So we had a, we had the increase in our accounts payable. So we had money paid out this year, but the expense it related to was taken last year and deducted from last year's net income. So anyway, once we make all these adjustments, we're starting with net income. And don't worry if you don't get all this right now. It becomes clearer as we go along. We start at net income, we make these adjustments, and we get to the actual cash that was generated by that net income. Okay, so operating is the only section where we do that. We start with the net income, we make the adjustments, we get it from the cash provided by operating activities. Investing activities are fairly straightforward. We used cash to buy a building, we used cash to buy equipment, and we got cash from selling some equipment. So we're not making any adjustments to net income in this section. We simply are reporting, what the cash was used for, and or where we got the cash for investing activities. Cash flow from financing, we got some cash by issuing stock, and then we used some cash to pay dividends. And again, there's no adjustments being made, it's simply what happened. So we compute, going back to looking at the statement, we compute, we had 172,000 provided by operating activities, okay? We used up 141,000 in investing activities, and we used a net of 9,000 for financing activities. When we add all of those up, we get, and leave off this non-cash for the moment, get that out of there, we end up with the change in cash of 22,000. If you look, well, that gives us the increase in cash. Okay, and then at the bottom, they add that to the cash at the beginning, which was 33,000, and you get the cash at the end of the period, okay, which was 55. So that's the basic layout of the statement. The only other section is the non-cash investing and financing activities, and that's where if we issue bonds to buy land, there's no cash that was impacted there. We simply issued bonds and we got the land. We could convert bonds to common stock. We could have, bonds that could be, callable and changed to common stock. There's all kinds of things that can happen where it's just non-cash exchange of assets. But those still get included on the bottom of the statement. So we've seen what the statement looks like and what's on it. And then I think I want to do another little podcast on what kind of useful information it will provide.